I just realized the other day that today, this is my 321st podcast or podcast episode. I started doing these weekend podcasts the first Saturday in 2010, and I have not missed a Saturday since I started that, which I'm in my second month of my seventh year. So I'm really proud of that. I committed to starting a dialogue and a conversation, one that I felt could be much more direct and straightforward, one that could eliminate the noise and the let's just talk about it because it's interesting. I mean, there's a lot of things you can bring up that are really interesting, but are they important? And what my commitment was to do for you was to find what's most important for your money and show it to you in the clearest way so you could go, oh, I completely get what that is. I feel empowered to do something about it, and I know what I can do next or what I should do next if I, in fact, want to. Because today there's just so much information out there. And look, it is interesting. It is interesting that a lot of the stuff that's going on, and I'm interested in a lot of it too, but I always go back to, is this important? Is this important to people's money? Hey everybody, this is RC Peck, and this is my 321st weekend podcast. And the theme for this weekend's podcast is, if you have to be in. All right, so if you have to be in the market, then this is the place that you're going to want to be. Now, not with this guy, but I can imagine the thought bubbles above these people, like the one woman looking at the other three people saying, and this to me looks like it's happening somewhere in Russia because of the church in the background. But the thought bubble for the woman on the right would be, why is he in? And then the other people would be like, his broker told him he always had to be in. He always had to be in the market. His broker told him he had to do this, right? So, people often believe that they always have to be in the market. But actually, that's not true. And if you've just noticed that there's periods of times where you actually do not want to be in the stock market, then you will start to recognize that maybe your big box advisor or your conventional advisor do not have your best interest at heart. They have their mortgage getting paid at heart. They're not good or bad people. They're just people like all of us with a bias. And most big box in independent advisors' bias is gotta pay the bills. So if you have to be in the stock market, then I have two price charts that very clearly tell you what to do. So the first one is looking at the consumer staples sector, which is the black line on the screen, comparing it to the S&P 500, which is the green line. And we're looking at about 2 years of data, so 24 months of data. So first of all, the first thing that strikes me, if you look at the green line, it's pretty much flat. I mean, obviously it's gone up and it's gone down, and it's gone up and it's gone down. But if you look at where it started and where it is today, after 2 years, it's up about 4%. But man, it keeps coming back to that horizontal line. So that's the S&P 500. But then if you look at the black line, that's consumer staples. So that's consumer staples, right? Think Procter & Gamble, J&J, Johnson & Johnson. Now look at that. That, though there's been some ups and downs, notice the lows are getting higher, right? You're looking at the lows here. The lows are getting higher. Generally speaking, over time, the lows are getting higher and the highs are getting higher. So if you have to be in the stock market, you might as well be in one of the strongest or the strongest sector in the S&P 500. And depending on how you break down the S&P, you either believe there are 9 sectors or there's 10 sectors. So whether you believe there's 9 or 10, this is the strongest sector, and it's up about 19% over the last 2 years. By the way, which has one of the most stable and large dividends out of all of the sectors. So what this price chart is telling us is the people who are in the market, what they're saying to themselves is, well, if I have to be in the market, then I want to be in those large corporations that pay a good dividend, that raise their dividend, that are big in size, like Procter & Gamble and Johnson & Johnson, that, look, if I'm going to be in the stock market, I want to be in the safest part of the stock market. And so people are keeping their money in the consumer staple companies, right? Band-Aids, baby food, things like that, things you have to buy, because they don't necessarily want to be in the stock market because, well, of their age, or they're getting tired of those 50% drops in the stock market. But look, the bond market's paying 0 or 1 or 2%. And so they're having to look for more. They're having to literally look for yield. So I love this because this is so clear. This picture is so clear. Consumer staples is the strongest sector today in the stock market. Now, the second picture I have is looking at the financials, which is another sector of the S&P 500. The financials is the black line on this screen. And again, this is a 2-year chart, and the green line is the S&P 500. So now look, the financials are not doing well. I mean, you can look at the screen and see that it has taken a really big hit from a high of, now over on the right, that's not actually showing you, it's just showing you relative to, 100, what the lines are above or below it. So on this screen right here, the green line's at about 103-ish. That just means it's up 3.5%, 4% for the last 2 years. But if you look at financials, it's down 5% over the last 2 years. And it actually took a pretty big fall from July of last year till, well, it's probably still falling, but certainly that fall, when you compare that to the S&P, it was pretty much doing everything the S&P was doing. I mean, look at how the green line and the black line, they just stick together. But then something happened in 2016. What happened in 2016? They separated. Financials kept falling, and the S&P is just, it's still kind of just going sideways. It's in that channel that I've talked with you about, that 18 to 24 month channel. It's just kind of going sideways, trying to figure out. But look at the financials. The financials have decoupled, have separated from the overall market, and they're acting very different right now. Now, if you believe financials are going to turn around, that's fine. You have yourself a turnaround candidate here. But what's happening right now, especially in 2016, is people are saying, I don't know, I don't quite know if I want to put my money in Bank of America or Citigroup. Now, this doesn't include Deutsche Bank or UBS or Credit Suisse, which those are in Europe. But people are saying, I'm not quite sure if they're stable enough to sustain what's coming forward. So I'm going to go put my money over into those consumer staples. And so that's what's happening right now. In 2 charts, you can clearly see one of the worst sectors in the S&P and the best sector. So if you have to be in, you now have a clear idea of what you can do next. And this is just one of the things I love about price charts, is they communicate to us such a clear story. So what is the takeaway? If it's not already clear to you, if you have to be in the market, be in the sectors, or be in sectors that are strong. And in this case right now, XLP, consumer staples, is a strong sector, and financials is not a strong sector. Now, it doesn't mean consumers are going to continue to be, and consumer staples will continue to be a strong sector, and financials will continue weakening. But it does definitely say to you, something has changed, and what is wrong with that sector that has received hundreds of billions of dollars, if not trillions of dollars of support, and it is still horrible looking? Maybe that's saying something up ahead ain't what it's supposed to be. So this is just another step in helping you protect your portfolio and secure your future. Until next time, this is RC Peck.